One top money manager suggests it's hard to fight Nvidia's bullish force in the market. Ben Emons is the senior portfolio manager and head of fixed income at NewEdge Wealth. Ben, you've heard the conversation so far. Is Nvidia the most important stock on planet Earth? I think that's what the Goldman's trading desk called it earlier this week.
Yeah, it is a really good acronym. I think, if you step back from a macro perspective, you take Nvidia as its impact on the broader market, its beta to the market is like over 2 to 1, right? So it has a real impact, as we saw. And as that's happening, the financial conditions are starting to loosen out quite a bit. I mean, in fact, that financial conditions index is at the 2021 high when we had apparently a bubble in the market. So that financial conditions is going to affect the economy. And it's, I think, happening. And maybe to Bonneman's point and to Carter's point, like you're seeing other stocks reacting now that are the real economy. So I think there's something going on from Nvidia spilling over to the broader market and then to the economy.
But there's a balancing point, right? You have Nvidia stock doing what it's doing, but you've also got interest rates, both medium and longer term, continuing to go higher. That's tightening, right? So in your fixed income and equity hat, how does it all play out from a balance perspective?
So this is really interesting that one stock can actually affect interest rate expectations. Because I was looking at that, like how Nvidia changed with the stock, what's happening with the rate cuts being priced in. So over the last sort of, say, 2 weeks, that Nvidia has really exploded. We've had taken out roughly about one rate cut out of yields, right? So now that's not all Nvidia, obviously, but it's the idea of that Nvidia as being the important stock to the economy currently, affecting the economy, I guess, through financial conditions, that therefore yields are starting to rise. And look, we've broken out of the 100-day moving average on the 10-year at 435 today. That does open to I think, a next move higher if the next rate cut gets priced out. So I think eyes are on Nvidia and the effect on the economy, and rates are paying attention.
Yeah, we're doing nothing on interest rates in terms of expectations, really out now through almost July. And I guess, Ben, good news is good news for stocks. It's been good news, and that's great to see. One of the news stories that caught my eye today is that the Dutch central bank had a minus 660% year-over-year loss, and whatever that really means, the point is that central banks are issuing at much higher rates and have an interest expense that is far exceeding where they are in terms of interest income. The dynamics here, to me, are that the rest of the world is going to continue to see higher interest rates, and that's going to pull up rates here in the U.S. Japan is rumored to be going in the March meeting to probably really officially moving away from interest rate and yield curve targeting. Just thoughts on because I agree with you. I think yields are going higher, and at some point I think equities are going to pay for it. But right now, it feels very orderly, and it feels interesting.
Indeed, it's like an orderly move, and the position in interest rates is not so stretched currently. But I think to your point, like it's happening globally. Let's pay attention a little bit to China, right? They finally started a rally there. It's up, like, I think, about 10% since the start of the month. As that stimulus start to maybe affect their economy for real, and so you're getting this bit of emerging market dynamic here, too, of economy starting to come alive, PMI data getting better, so global rates are starting to move up. And I think what we're dealing with is a situation where these rate cuts being priced in were clearly overextended when we started the year. They've been taken back. Now the scenario is on the table that we may not have any rate cuts at all this year. And if I listen to the Fed over the last 24 hours, they're getting quite doubtful about that they can actually cut rates this year, right? So that's not only...
It should be.
Right, and it's not only here, but it's in Europe too. So, yes, I agree with you. We're probably in a phase here. There's good news driving up yields. Obviously, at some point, you get to tightening, and that's not yet happening.
What is driving? I mean, at the end of the day, I mean, look, it's always this way where people are expecting something. It's not what happens. We heard higher for longer. We crossed 5%. What happened? It drops to 3.8 on the 10-year. Basically, isn't this the sweet spot for rates? Who cares if it's 5 or 4? You drop to 2, something's wrong on Main Street. You rally to 7% yields, you got to change your DCF model and your assumptions for price targets. But sitting here at 4%, 4.25%, it shouldn't matter.
Yeah, I guess you're right, Carter, that you have, like, say, rates are at neutral, quote, unquote. Yes. Meaning, right, the economy is growing above potential, inflation is trending slowly down, so rates are kind of reflecting that sort of neutral level, and the Fed is at 5.5. So, some people say you're probably a little tight with the Fed here, but I think that long term, if you're going to go back to the Fed's neutral rate of the 2.5% that they still have in that dot plot, then we're in an economy that's far weaker. So I guess we're sizzling nicely here with rates. You could probably go back to 5% just for the technicals that we were highlighting. but we're not really, let's say, overstretched. So the 7% scenario seems to be unlikely. It seems to be more like ranging here in this 4.5 up to 5.